The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients.
All right, welcome everybody. We're at the top of the hour to our biggest, most sought after live webinar of the year. I'm your host, AJ Wolfe, Wolfe on the Street podcast, which everybody knows and loves. Guys, very lucky today. Got a lot of really good stuff. We are joined by arguably the most well-known, renowned economist of all time, the one and only Emeritus Professor, Wharton University, Jeremy Siegel. Professor, it's great to have you here.
Good to be with you, AJ.
Yeah, thank you very much. And before we get going into the interview, I do want to take a quick second just to again say thank you, Professor, not just for you. I know we were just chatting. You're down in Florida. Your wife's at the beach. You're going to be going to meet her after this, but obviously valuable time out of your day. Greatly appreciate that. But also to all the advisors on the webinar today as well. I know your time is also very valuable. It's the end of the year, guys. We're scrambling. We got Christmas presents to buy, trying to get stuff in before last minute. But I can promise you that this webinar is going to bring a lot of value today. And I also want to thank you guys not only for having a record year at Quantum. Guys, personally, our Wolfpack team had a record year as well. So we can't do what we do without you, truly. And that's why this is so important to us. These webinars, this value add that we're bringing, we want to make sure that value and keeping you guys informed on everything, annuities and other. Again, we've got Jeremy Siegel on today, giving a market outlook 2026. No other IMOs are bringing this type of value. So without further ado, I would like to again introduce Professor Jeremy Siegel. And you guys will have to bear with me as I read these accolades. It's obviously quite impressive on how successful his career has been. So Russell E. Palmer, Professor Emeritus, Finance at the University of Pennsylvania's Wharton School, also served as Academic Director for the U.S. Securities and Industry Institute. Major works, guys, not one, two books. Author Stocks for the Long Run, considered obviously a landmark investment book, and The Future for Investors, both acclaimed for their insights into asset performance. Media presence, guys, he's not just wasting his time on little old me. We're talking CNN, CNBC every Friday, Kiplinger, Yahoo Finance. This guy is everywhere. And then awards, right? Honored with the CFA Institute's Nicholas Molodovsky Award, the Graham and Dodd Award, and several teaching awards. And he wraps that all up, if that couldn't be enough, he wraps it all up as a senior investment strategy advisor at WisdomTree. Which is the sponsor for ETFs, where he's also got a few index options with our partners at Annexus on their Athene BCA annuity that many of you are very familiar with and use in your everyday practice. So, Professor Siegel, again, huge thanks for you today and very honored. And before I start, little fun fact, after doing some research the last couple of weeks, having you on the show, I did realize we've got the same birthday, believe it or not, November 14th.
Oh, November 14th.
November 14th. So I know they usually say great minds think alike, but I'm starting to wonder if great minds are born alike. I'm just gonna throw that out there. I'll let the listeners take it for what
I don't know if you know this, AJ, but the King of England also, King Charles, is also born on November 14th.
It just keeps going, right? So I appreciate that.
Right?
I appreciate it. Oh, that's fantastic. And hey, I want to be respectful of time for everybody today. We've got 30 minutes and we've got a lot of really good stuff. And I reached out to a lot of our top clients, top advisors, and obviously I heard the same thing over and over. So I wanted to start off today. You and I chatted a little bit this morning already. Your view of the FOMC's monetary policy going forward. And you know, if you were in Powell's shoes, right, what actions would you take given the recent unemployment data slipping while the tariffs are still causing inflation?
Yeah. Very, very good questions. All right. First, let's talk about the candidates. I think all three candidates are very good. Very good. Kevin Hassett, Kevin Warsh, and Chris Waller. My personal preference would be for Kevin Warsh. I think he has really deep understanding of monetary history in a way I think is meaningful. Kevin Hassett, who was at one point kind of prohibited front runners, now kind of slipped a little bit, but I know him very well. I actually campaigned with him for John McCain in his for the nomination in 2000, and I was the lead economist with him. He's a very good economist. I just don't think he has the monetary background as much as either Waller or Warsh. But any of the three would be good. I think Warsh would be really good. And one has to remember that Jay Powell, never came from a formal macroeconomic or economic
Sure.
background. He was in private capital. So, I mean, in terms of background, all of these people that were being considered are PhD economists. So, one shouldn't say, hey, I mean, these are people with high credentials.
Love that. All really good points. Great points. And I guess tying right into that, what does a Trump appointed Fed chair mean for equity markets?
Right. Well, first, let me tell you, yeah, as you said, what I would do. I have said for a long time, and I've been on the record and on all the major networks, that the Fed funds rate should be from somewhere between 3 and 3.5%. And the reason is the following: if you do historical research, you see that the Fed funds rate over the last 75 years has averaged 109 basis points below the 10-year Treasury. So a little bit more than 1 percentage point. Where do we have the 10-year Treasury right now? It's about what, 415.
Mm-hmm.
So that means we should be in the low threes for the Fed funds rate. Now we're getting down there, not quite there. I'd put it down another 50 basis points, whether it's down all in January and March, one could talk about. Obviously, things deteriorate. You go down more. If they don't, they go down. But right now, my feeling is we need another 50, 75, okay, basis points down on that. I think that's good for the equity price. And now, let me say the following. A lot of people say, well, what does that mean for the 10-year? I'm not predicting the 10-year moving very much. 10-year, I think, is going to stay in the 4 and the 4.5% range. And then people ask me, well, then how is it going to do any good? One has to remember, long-term rates are only one part of the credit market. There are over $15 trillion of loans that are pegged exactly to the Fed funds rates. In other words, short-term interest rates. And those are going down. So, and by the way, consumer rate, the prime rate is 3 percentage points exactly above Fed funds rate. Credit card rates are above that prime rate. Home equity, HELOC loans are all on the prime rate, are all on those rates. The LIBOR loans, the SOFR loans, I could go on and on and on. So it's going to, whether the long rate goes down or not, there's going to be relief on the short side through lowering that rates, and I think that's definitely a positive for the economy.
Incredible insights, incredible stuff. I'm taking notes. Obviously, this is going to be recorded for all the advisors out there, but just great stuff to think about. And I think this is a great transition because along with the Fed and interest rates, the number one thing I'm hearing from again clients is the AI, right? The boom, the bust, and I know this is obviously a huge topic in Washington. Professor, do you think we're on the precipice of an AI
Yeah.
bubble?
No, well, precipice, there's a lot I think we're at a precipice of higher productivity growth. I do not think we're in an AI bubble. Now, let me be very careful. AJ, I think bubble is one of the most overused terms in all finance. I mean, anything that's going up, people say it's a bubble, or that they don't think it's
Sure.
justified going up, or if it's 10% above their target, it's a bubble. I mean, a bubble is something really extreme, 2 to 3 times above what you think it should be. And I don't think AI is there. I mean, again, if you take, for instance, let's take the Mag 7. Now I'm taking out Tesla because Tesla's a very special case. As we know, it's 150 times earnings. It's all on options for the self-driving and SpaceX and everything else that Musk does. outside of that, you're kind of like on 30 times forward earnings. That's not a bubble. I'm not saying it's right. I'm not saying that it's undervalued. I'm just saying that it is nowhere like what we saw in 2000 with the internet stocks that were selling 100 to 200 times earnings.
Great point.
And so that was a bubble. This is not a bubble. Now, the question is, we've had a little wobbliness on the Mag 7, a little bit on that. I think that's healthy. I think, you want to shake out every now and then. I do see a broadening out. If I had to make a pick, I would say this would be maybe the first year in 3 or 4 years where we would actually see maybe Mag 7 underperform the broad S&P. But I don't do that. I'm not going to say that with, it's absolutely going to happen. We've really had the longest increase in growth stocks relative to value stocks, which has gone on for 15 years, than we've had in the 100 years of data in the Center of Research and Security Prices. So it's unprecedented what we've seen. So we are, to just, once you're in an unprecedented type of move, it's, don't say, oh, it's just got to end the next year. It doesn't. But if I were to say what I'm seeing there, little bit of doubts about the build out, a little bit of doubts about a couple other things. I could see maybe that's going to be a 5 to 10% return next year versus 10 to 15 for the non-Mag 7, non-tech market.
Well, and I love that. And again, you've been doing this an incredibly long time, and this ties in, I think, perfectly, Professor, to the next question I'm hearing a lot is what would you say, or what would you argue is the biggest threat to the economy in the coming year? Because I'm seeing a lot of analysts, right, kind of targeting S&P 7,500, 8,000, and that's quite a bit of optimism, again, from my point of view, in capital markets forecasting, right, perspective, given the last 3 years, we've had double-digit returns.
Yeah, we've had double-digit returns, but we've also had double-digit earnings increases. And so we're really growing into those. And we have the tax cut, which is going to continue to increase those earnings and favorable margins. Doesn't mean that, listen, we all know uncertain, geopolitical events. I mean, remember, we're only 6 years from the pandemic.
Sure.
All of a sudden, out of the blue, the pandemic hit in February and March of 2000. So, I mean, anything basically can happen. There are always risks out there. When people ask me, is there anything that keeps me up at night? Well, I actually sleep fairly well, but if there were, I would say we've got to maintain our cybersecurity. That's the thing what I sometimes worry about. I mean, I don't want everyone to wake up in the morning, go to their bank account, can't get to it, go to their brokerage account, can't get to it. Someone has hacked through the whole financial system. I mean, that would be a disaster. We have to treat cybersecurity on our financial system and of course, all our military and government system as equivalent to national defense. I mean, we have to spend money. There's we spend tanks and missiles and all the rest. We've got to boilerplate our internet in a way that no bad actors could come to it. This might also include upgrading the grid, which we know has some strains potentially on there. So that's something that I think should always be a priority of the United States, and I don't think there's a lot of disagreement on that. It's just something that we just have to keep in mind. But outside of that, is there anything? I see two little bumps ahead. I mean, we might get in the next couple of weeks a statement about Trump's tariffs from the Supreme Court. Now, what would that mean? It's possible that the Supreme Court will actually give him 6 months to say, it's not an emergency, but we'll give you 6 months to get it through the Senate, what you want, and they would negotiate with the Senate, which I actually think he should have done to begin with. I was not a fan of the way he did these tariffs. That would be a good outcome if he worked with the Senate. The other bump, let's face it, we have a potential of another government shutdown on January 30th. So, I mean, no one wants that again. But nothing is solved there yet. So we got to go through those two bumps, and once we do, if we do manage them successfully, I don't see any substantial clouds in the future.
Cybersecurity, I couldn't agree with you enough. Actually, a gentleman on my team just fell privy to that exact thing, identity theft. Oh my
Mm.
gosh, I couldn't tell you the nightmare that he had to go through just to get everything fixed. So that's very
And
great
Jay,
point
and you
there.
know what's amazing? I mean, I'm sure he's a smart person. I mean, I know some very smart people. They are so clever they can even fool you, even as an extraordinarily smart person. It's not just, oh yeah, here you're dumb, you fall for this. And but that's one type of thing, those type of thefts. But then there's the thing about let's make sure that all our accounts and banks are not hacked. That's another major threat.
Well, and I know good-looking guys like ourselves, we get hit up by Dubai princesses all the time, right? Trying to get us to send some money. No, I digress. But no, that's all great insight. Thank you. And Professor, I'd maybe shift the conversation here quickly on, what I might refer to as temporary permanent, right, if you will. And there's a big question on the traditional stock bond diversification model, right? And I'm curious your thoughts. Has that for the most part kind of died off, or are those shifts that we're seeing from that front just a little bit more temporary? And obviously, with your kind of coverage on the index annuities, are we still looking that way from kind of that bond alternative, if you will?
Yeah. Well, as you know, in the long run, I'm a real fan of equities
Sure.
because of first of all, they are excellent long-term hedge against inflation, which bonds are not, unless you go to the TIPS route, and we know the yields are under 2% in that route. I think my long when people ask me long run, what do you think returns in the stocks are going to be? I say a little bit lower, certainly than we've seen the last 20 or 30 years, but I still say 5 to 5.5% after inflation. Remember, tips are less than 2%.
Sure.
So there is a good gap there. And over 20, 30 years, that gap, as you know, if you can have a 3% outperformance per year after 30 years, you're going to, double, triple. And so that's important. Bonds are good short-term hedges against a number of different risks, geopolitical risks, recession risks, pandemic risks, you name it. But it's a short-term hedge, and it's a very bad hedge against inflation risk. So, if you're worried about the deficit in the long term, that's an inflationary type of potential. And I want to be in real assets. If I worry about inflation, I want to be in real assets. I want to be stocks because those are claims on real capital, plant, equipment, land, factories, trademarks, copyrights, intellectual property, you name it. That's real. And that's what gives the value to equities. Also property, and that's another great hedge against inflation.
Sure.
Again, stock bonds are those great short-term hedges. They're just not such great long-term hedges.
Well, and staying there for a minute, because again, that's obviously a big topic that we're having, all the time with advisors, and you've done some incredible work on real returns, right? I know we've read about that in your books and things like that, and what can advisors maybe realistically expect in 2026 from bonds, and to maybe add on to that a little bit is, where do you see the best opportunities for kind of preserving that purchasing power, if you will?
Well, purchasing power, it's got to be real assets of some sort. Now, I know gold has really shot up. I tell people, and they ask me about Bitcoin and gold. I said, listen, if you want to do 5% gold, 5% Bitcoin, I'm not going to argue with you. 10% in that. I just want to tell you that the long run real return on gold, even though it's been spectacular recently, is only 1% above inflation. Oh, since 1800 onward. Don't forget, I mean, gold is a wonderful precious metal. It is scarce, but it has no production that an equity that has earnings potential with
Great point.
capital. Yeah, that's the big difference. So you got to remember that. Bitcoin, I don't think I'll ever I never have, and I'm not going to make a prediction on Bitcoin. I have a lot of views on Bitcoin, why it is spun up so much. So again, I don't mind a little allocation there. But I still think if I rather have real assets in my portfolio, property or stocks as that hedge against inflation, as a better long-term hedge, I think, than gold from current levels because it has shot up so much. I think that gold, just might have 1-2% per year next 10 years. I may be wrong, of course. I'm just saying that I think equities are 5 to 6.
Love that. And I perfect. I would love to stay right there just for a minute because again, you've written extensively on inflation as well. So kind of tying here, your thoughts, policymakers, right? What do they still misunderstand about inflation's long-term effect on asset prices?
Well, first of all, policymakers have, and I put the Fed here, as you know, I think
Yes.
totally misunderstood how important the money supply was, and they let the money supply
Yes.
go out of control in 2020, and for 2 years, and caused all that inflation. And they got to have a Fed chair that understands that. I think Kevin Warsh, for instance, is definitely a Fed chair that understands it. So as far as controlling inflation, they've got to have someone that understands it. Secondly, I think what advisors have to know, and it's what we've been just talking about over the last 20 minutes, is that you've got to have real assets in your portfolio, and stocks are real assets. Yes, they're represented, by financial assets, piece of paper, but that piece of paper represents productive, real capital. As I mentioned, land, equipment, copyrights, intellectual property. Those are real assets. And my studies, I mean, let me just give you a kind of I think a startling but very insightful statistic. When we used to be on the gold standard all the way until, basically the end of the 1930s,
Sure.
we had virtually no inflation from 1800 to 1940. And the real return on stocks was 6 to 7% per year. Since we went off the gold supply with Roosevelt and then again under Nixon, we've had a 3,000 percentage point cumulative inflation, not per year, cumulative. The prices are 30 times higher. I mean, a dollar in 1940 buys less than 4 pennies of what it buys today. And what has been your return in the stock market? It's been 6.5 to 7% per year after that inflation. Because it's a claim on real asset, it just totally offsets it. And that's a real important lesson for advisors, and especially for advisors that have clients. And some of these fears are definitely justified, that worry about our deficit and what's going to happen. Is the Fed just going to print money again? You've
Mm-hmm.
got to have real assets. And I like real productive assets, not just gold, which is, a good non-productive
Sure.
real asset, but real productive assets. The long-term stocks as a long-term inflation hedge are one of the most perfect hedges you can buy.
I love that. And incredible statistics with their 3,000%. I mean, that's not a joke. So incredible statistics. And I'd say here, Professor, the last 5-10 minutes, I do kind of maybe want to shift to what we'll call the long haul, the long term, right? A lot of advisors have been eagerly awaiting kind of, okay, we're here, where next? And, over that long haul, right? The next 5-10 years, whatever that might be, are there any factors that you're seeing that most investors might be overlooking when
Well,
it
we're all
comes
talking
to?
about AI, and the
Correct.
adoption of AI is a big question mark. Yeah, I think AI has greater potential than the internet. I think AI is a tremendous offset to our population rate decline, as you know, especially now that we've controlled the immigrants coming in. We know we don't have the labor supply we did before. And that's why AI is very, very important to generate efficiency so one person can do more. I mean, we might actually have more people in the sense of robots. I'm not going to speculate on how far ahead that will be. I think actually in my opinion, and I have to say, AJ, I'm not an AI expert. I'm a monetary theory policy expert. Of course, I look at all this. I think the biggest AI breakthrough that's going to have a lot of significance is self-driving. I mean, we have over 1 million truck drivers on the road, and we had taxi drivers, Uber drivers, and all that, and all the rest. That we could get to full self-driving within 3 or 4 or 5 years.
Crazy.
That frees up an office, and that's a huge AI use. But we also know that AI has unbelievable other uses, and by the way, other people are going to find jobs. We keep on rotating to people. I'm not worried about that. Temporary people have to learn, new skills, and that's been throughout history. I mean, in 1800, 80% of U.S. workers worked on the farm. Today, it's less than 2%, and yet we have the most productive economy in the world. Back in 1947, 45% of workers worked in factories. Today, it's 7 or 8%.
Wow.
And we have the most productive economy in the world. So it's always going to rotate and always find new outlets and new tasks and goods and services, particularly. And we know healthcare does absorb a lot of people. We're getting
Sure.
older. We know that that's actually the biggest hiring of the last 10 years is really the healthcare industry.
Wow.
In terms of needing bodies to help with an aging population. So there's always going to be a demand, but we're going to have technology help us to substitute in the other fields that'll increase the well-being and productivity of the average person to keep wages growing, keep our economy growing, and keeping our equity market growing also.
I love that. Self-driving is a very good point. We've got enough Waymos here in Scottsdale. They're starting to take over the streets. And I'll tell you that farming statistic really hits close to home. Professor, I'm born and raised in Iowa, spent the summers on the farm with the grandparents. And you see it when you go back and visit, right? It's just kind of not the same. So very interesting statistic on the farming community. And maybe I'd finish up with this, and I'm very curious. A lot of the advisors listening today, obviously Quantum, we only work with the best. We only work with, some of the top advisors in the country. And everybody on here is great at keeping clients disciplined, right? And not to make irrational decisions. So what do you think in the last couple of minutes here, and then I'll let you give your mic drop moment. What do you think investors are most likely to get wrong in 2026? And what can these advisors today, what can they do to help them avoid it?
Well, this is one of the biggest, I think, positives of advisors. Having a long-term perspective, keeping your clients in the market. Listen, AJ, we're going to have a bear market eventually.
Sure.
We're going to have volatility. We're going to have some, scary days. And clients are going to say, oh, my God, the world's coming to an end. They want to get out, and all the rest. As an advisor, if you're able to calm them down, show them some history, show them what they went through and what mistakes it is to go out of the market in those periods, you've earned your weight in gold. Let me say that. And that is keeping that long-term focus, because that's why so many people don't get the returns they should, is they don't have someone to guide them through the volatility. And even though, I think next year might be a very good year, you never know. And that, listen, part of capitalism is bear markets. There's going to be one. And you have to be able to, to manage your clients through those. And if you can, boy, you've done a wonderful thing for your investors.
I think that's incredible. And if your clients, you can't talk them off the ledge, they do want to get out, I would suggest calling the host of this show. We might have something that we can help them with. So, Professor, in the last 30 seconds, I would like to open the floor up to you. If there's anything that we missed today that you'd like to add, again, I cannot thank you enough. I know I speak for the the several hundred advisors, I believe, that actually registered for this event today. It's been some incredible insight. So I'll leave it up to you the last 60 seconds if you want to add anything.
Well, a lot of people, let me say an old maxim of the market is the market climbs the wall of worry. But what I hear people say is, oh, there's too many clouds in the sky. There are too many threats in the cloud. You will never invest when there's only blue sky. And if you find only blue sky, that's not the time to invest. If no one sees a problem, there's always going to be a problem. So don't use that as an excuse to say, oh, yeah, until this clears up, until that clears up, until I know this or that, then I'll move in. This has been the way the world has been for 200 years, and the returns through sticking through all these uncertainties are well proven.
I love that. Great words of wisdom to kind of cast out this webinar on. So, Professor, I'll let you get to the beach. Make sure you get some sunscreen up on top there. And to all the advisors listening, again, I cannot thank you guys enough for helping us do what we do, right? And we're looking forward to 2026. Strap in. There's going to be a lot more of this. I don't know if they're going to be as good, right? These are big shoes to fill from a guy like Professor Siegel, but we got a lot of neat stuff coming down the pipe. And I just want to wish you all a very Merry Christmas, Happy Holidays. Thanks very much, Professor. Take care.
Thank you. Thank you now.